On Thursday, March 9, 2023, more than $40 billion left Silicon Valley Bank. By the next morning, customers were trying to pull out more than $100 billion more. The bank could not meet the demand. Regulators closed it before the business day was over. That sounds like a 48-hour collapse. It was not. The run was the final stage of a failure that had been building for years. Inside the bank's customer base, inside its securities portfolio, inside its risk models, and inside a supervisory system that saw problems but did not force them to be fixed in time. To understand what happened, we need to follow $1 through the entire machine. Silicon Valley Bank was founded in 1983 in Santa Clara, California. It was not designed like a normal retail bank. Its core clients were technology companies, life science firms, venture capital funds, and the people behind them. That specialization was its advantage. A startup could keep its operating cash at SVB, borrow from it, and remain a client as it grew. The bank said it served nearly half of venture-backed technology and life science companies in the United States. The Federal Reserve later described the resulting customer base as heavily concentrated. Then the technology boom turned that concentration into extraordinary growth. Between 2019 and 2021, SVB Financial Group tripled in size. From the end of 2018 to the end of 2021, its assets grew by 271%, while assets across the banking industry grew by 29%. The mechanism was simple. Venture investors sent money to startups. Startups deposited much of that money at SVB. At the end of 2022, venture-backed companies still accounted for more than half of the bank group's deposits. But deposits are not just money sitting in a vault. For a bank, they are funding. SVB had to put that flood of cash somewhere. It made loans. But it also bought a very large portfolio of government and agency-backed securities, including mortgage-backed securities. These assets carried low credit risk. The central danger was not that the United States government or a federal agency would suddenly stop paying. The danger was time. Imagine a bond that pays a fixed rate for years. If newly issued bonds begin paying much more, an investor will not pay full price for the older, lower-yielding bond. Its market value falls. If the owner can hold that bond until maturity, it may continue receiving the promised payments. But if the owner needs cash immediately and must sell, the lower market value becomes a real loss. This is where SVB's balance sheet became unusually exposed. At the end of 2022, securities represented 55% of its assets, compared with 25% for its large bank peer group. And 78% of its securities were classified as held to maturity, compared with 42% for those peers. Held to maturity accounting allowed those securities to remain recorded at amortized cost instead of moving with their market price. But the classification came with a practical constraint. Selling from that portfolio could force a much broader reclassification and mark-to-market adjustment. SVB's held-to-maturity portfolio had a weighted average duration of 6.2 years. Most of it consisted of agency mortgage-backed securities with maturities of 10 years or more. Long assets are not automatically fatal. The other side of the balance sheet matters just as much. At year-end 2022, approximately 94% of SVB Financial Group's deposits were uninsured. The comparable figure for its large bank peer group was 41%. FDIC insurance normally covers up to $250,000 per depositor, per insured bank, for each account ownership category. For a household, that can protect an entire savings account. For a company holding millions of dollars for payroll and operations, it can cover only a small fraction. So SVB had combined long-duration assets with a deposit base that could move quickly and had strong reasons to move at the first sign of danger. The balance sheet was running on two different clocks. On the asset side, a large share of the bank's money was committed for years. On the funding side, depositors could request their money in seconds. Banks manage that mismatch every day, but they depend on a crucial assumption. Not everyone will leave at the same time. SVB's customer concentration made that assumption unusually fragile. Its depositors were not a random sample of millions of unrelated households. Many were companies exposed to the same funding cycle, advised by the same venture firms, and connected through the same professional networks. The concentration worked in both directions. When venture capital flooded into technology companies, deposits rose together. When funding slowed and companies needed cash, deposits fell together. For a while, low interest rates and abundant venture funding made that structure look profitable. Then both conditions reversed. In 2022, the Federal Reserve raised its target interest rate range by 425 basis points, moving it from 0 to 1/4% at the start of the year to 4.25 to 4.5% by December. Higher rates pushed down the market value of older fixed-rate securities. At the same time, venture activity slowed. Startups received less new funding and spent more of the cash they already held. Deposits began to leave. The bank was being squeezed from both directions. Its funding was shrinking, while selling assets to replace that funding could reveal losses that had accumulated as rates rose. This distinction matters. An unrealized loss is not imaginary, but it is not automatically a cash loss either. It measures the gap between an asset's recorded value and what the market would pay for it now. The gap becomes unavoidable when the owner has to sell. That meant confidence and liquidity were tied together. As long as depositors stayed, SVB had time. If enough depositors left, the bank needed cash. To raise cash, it could be forced to sell securities. Selling could crystallize losses and weaken capital, giving even more depositors a reason to leave. The balance sheet contained the possibility of a feedback loop. The question was whether the bank's risk management could interrupt it. This was not an unknowable risk. The Federal Reserve's post-failure review found fundamental weaknesses in SVB's management of interest rate risk. Management focused on short-term measures of income and did not adequately account for longer-term changes in the economic value of the balance sheet. The bank changed modeling assumptions when limits were breached and removed interest rate hedges that could have protected against rising rates. The same review found that the bank's board and management failed to manage the risks of rapid growth, its concentrated business model, and its reliance on uninsured deposits. But responsibility did not stop at the bank's doors. Federal Reserve supervisors had identified weaknesses. They did not fully appreciate how vulnerable the bank had become, and they did not act quickly or forcefully enough to make it correct the problems. At the time of failure, SVB had 31 unresolved safety and soundness supervisory findings, 3 times the average for peer banks. The Fed's own review also concluded that changes in regulation and a less assertive supervisory approach impeded effective oversight. A separate review by the Federal Reserve's Inspector General found that supervision did not evolve with the bank's growth and complexity. SVB had crossed from the Federal Reserve's regional bank portfolio into its large bank portfolio as it grew. But the transition did not immediately produce the level of scrutiny that its new size and unusual balance sheet required. The problem was not that regulators saw nothing. It was that warnings, ratings, staffing, and enforcement moved more slowly than the risk. The structure was fragile. On March 8th, the trigger arrived. SVB announced that it had sold $21 billion of available-for-sale securities. The sale produced a $1.8 billion after-tax loss. The bank also planned to raise $2.25 billion in new capital and increase its term borrowing. Management intended the restructuring to strengthen the bank. Many customers read it as a distress signal. This reaction was amplified by the design of SVB's own network. Venture firms and startup executives were financially connected, professionally connected, and communicating in real time. According to the Federal Reserve Review, social media and those concentrated relationships helped produce coordinated withdrawals at unprecedented speed. On March 9th, more than $40 billion left. California regulators later reported approximately $42 billion in withdrawals that day. By the evening, the bank had a negative cash balance of about $958 million. SVB then told supervisors it expected more than $100 billion in additional outflows on March 10th. Actual and expected withdrawals together represented roughly 85% of its deposit base. No bank keeps 85% of deposits in cash. SVB tried to obtain emergency liquidity, but operational weaknesses made the crisis worse. It had not tested its ability to borrow from the Federal Reserve's discount window in 2022 and did not have all the necessary collateral and arrangements ready. The Fed later concluded that better preparation probably would not have prevented failure, but it could have allowed a more orderly resolution. On the morning of Friday, March 10th, California's financial regulator closed Silicon Valley Bank and appointed the FDIC as receiver. The bank had approximately $209 billion in assets at year-end 2022. The immediate question was no longer whether SVB would survive. It was what would happen to the companies whose operating cash exceeded normal insurance limits. On Sunday, March 12th, the Treasury Secretary approved a systemic risk exception after recommendations from the Federal Reserve and FDIC boards. The government agencies announced that every depositor would have access to all of their money the next day. Shareholders and certain unsecured debt holders were not protected. Senior management was removed. The costs associated with protecting uninsured depositors at SVB and Signature Bank were assigned to the banking system through a special FDIC assessment, not a direct taxpayer charge. The decision protected depositors, not investors. It also created a difficult policy trade-off. Officials judged that leaving large depositors exposed could trigger runs at other banks, but protecting them could strengthen the expectation that the government will intervene again. That tension did not disappear when the deposits reopened on Monday. 2 weeks later, First Citizens Bank agreed to assume the bridge bank's deposits and loans. The transaction included about $72 billion of assets at a discount of $16.5 billion. About $90 billion in securities and other assets remained with the FDIC receivership for later disposition. So what actually killed Silicon Valley Bank? Not one bad bond. Not one social media post. Not one interest rate increase. It was a chain. A concentrated industry produced a concentrated deposit base. A boom delivered more cash than the bank could deploy through ordinary lending. Much of that cash went into long-duration securities. Rates rose. The securities lost market value. Venture funding slowed. And clients began spending their deposits. Management failed to control the combined interest rate and liquidity risk. Supervisors failed to make the bank correct known weaknesses quickly enough. Then the same network that had supplied the deposits transmitted fear almost instantly. The bank run was extraordinarily fast, but speed was not the root cause. Speed was the force that exposed every weakness at once. That is the larger lesson of SVB. A balance sheet can appear stable when each risk is viewed alone. Safe securities, loyal customers, strong growth, adequate capital, but a bank does not fail one line at a time. It fails when the lines connect.